All right. Hi, everyone out there. Welcome to the Program for Financial Studies. This is a very unusual webinar we're doing based on what we've done in the past. This has been in person, but not now. So welcome to our little get-together in a virtual sense. I'm Harry Mamaysky, so I'm the Faculty Director of the Program for Financial Studies. And to over there is Melina Dennebaum, who's the Program Director. So we together, do the PFS stuff. Today, we are very excited to have Joel Gantcher and Greg Landegger with us. You can see them on your screens as well. I'll tell you a little bit about them in 1 second. Our discussion today is going to be a little bit different than the usual Bitcoin crypto talk. We'll be much less technical. We're not going to do a primer on encryption, and we will not be discussing hash functions unless you want to discuss hash functions, but that's not what the focus is going to be. Really, the focus will be on how do you invest in the crypto ecosystem in terms of coins, like things like Ethereum and Bitcoin, but also in terms of the companies that populate this ecosystem. How do you as an investor identify opportunities that are interesting in this newly emerging wild, wild west of investing? So that's what our discussion will focus on, and we'll try to make it as interactive as we possibly can. So let me tell you a little bit about our two guests. So this is in alphabetical order. Joel Gantcher, who you see before you, leads the Gantcher Family Partners. It's a family office based in Florida. Joel has spent 2 decades investing into alternative investments. Until 2016, Joel worked at various fund of funds, where he invested in funds across a broad spectrum of geography, strategies, and asset classes. He was both a portfolio manager and head of investment research. Since 2016, Joel has worked with his family, where he focuses on sourcing and investing in niche, capacity-constrained investment opportunities, and I think that's what he's going to talk to us about today, and especially focused on the illiquid as well as the liquid part of the space. Prior to his investing career, Joel was both an investment banker and business consultant. He graduated from Brown. By the way, I also graduated from Brown, and later attended the Lauder Institute at UPenn, where he received an MBA from Wharton and an MA from the School of Arts and Sciences. So thank you, Joel, for joining us.
Thank you.
Greg Landegger is with us as well. He's an investor and early technology adopter, focusing on innovative digital developments across the field of cryptocurrencies and blockchain, gaming, extended reality, and data infrastructure. Greg began his career rising to hold global executive positions in the pulp and paper equipment manufacturing industry before transitioning to an analyst role in high-yield securities. He subsequently moved into private equity, where he led operations and turnarounds for asset managers in the food and water sector. Since 2015, he has directed venture and early stage investments at Parsons and Whittemore, a family office based in the New York City area. He graduated from Georgetown University School of Foreign Service. So no one came here to listen to me. I'm done. Joel and Greg, I'll throw a question to you guys. Can you give us a brief intro about yourselves and what it is that you do?
Go ahead, Greg.
So again, my name is Greg Landegger, and Parsons and Whittemore is a family office that for 3 generations was in the pulp and paper machinery industry, as well as we had a sister company called Black Clawson, which was the leading supplier of paper equipment to the manufacturing industry. Where that's of interest to the discussion at hand is we were an operating company and spent a lot of time discussing concepts like lean manufacturing, improved efficiencies, and ways to really improve our business operations. And as we talk through this, I'll explain that when we originally learned about blockchain technology, we actually thought it was a adaptation of lean manufacturing. We thought it was sort of lean manufacturing for administration, because you spoke about in the lean world, Toyota production system, you talk about removing waste from the system. In the crypto world, you talk about removing friction from the system. Both systems talk about transparent use, sharing information, and obviously when you got into blockchain, you added this level of immutability and decentralization, which got quite interesting to us. Joel?
Well, actually, Harry, I thought you did a really good job. There's not much more I want to add regarding my background other than, you know, while working at the hedge fund of funds and looking into hedge funds, I did spend quite a lot of time looking at smaller capacity strategies and under the radar strategies, which, you know, ultimately led me into this ecosystem that we're going to be speaking about today.
All right, great. Thank you guys for that little bit of background. So let me ask a follow-on question then. Now that we know a little bit about your backgrounds, how did you get into crypto investing? Like, what was it that brought you to this asset class, this ecosystem in the first place?
All right, well, I'll take this one, Greg. First, all very polite here. So when I joined my family office, it was with an eye towards migrating out of what one might call traditional alternatives investments like long short equity and long short credit, which had seen real alpha degradation over many years, the previous decade really. And so it was my goal to try to move us into some alternative strategies, which could hopefully generate better alpha going forward. And so I was constantly looking under rocks and came across this thing called cross-exchange arbitrage. And I had no idea what that meant when it was presented to me, but basically that's a really fancy way of saying that Bitcoin, at the time it was Bitcoin primarily, Bitcoin was trading at different prices on different exchanges around the world. And it wasn't like your classic arbitrage where you might be able to scalp a few basis points. There were real differences in the trading levels, and they were sort of 2 to 10%. And I didn't have any point of view on cryptocurrencies. Frankly, I didn't even really know what they were at the time. But this sort of got me into the door because the more I dug, the more I realized that there were real structural inefficiencies like in the ecosystem, which one could take advantage of, you know, with the requisite effort and research and resources. And so I spent probably 6 months researching that, went down the proverbial rabbit hole, which everybody ends up talking about when it comes to crypto. But my real entree was just this weird little arbitrage opportunity, which you know, went away entirely about 8 months later, for whatever that's worth. But I'm sure we'll get to the pace of innovation later. But that's how I got involved. And then as a family office, we have the luxury of being able to sort of go where we want, as opposed to, say, a fund of funds that always has to have, you know, like a sleeve of long short equity guys and macro guys and CTAs or whatever it is that they invest in. We're able to be extremely opportunistic. And I just ended up migrating towards crypto because I thought there were very interesting opportunities there.
It's very interesting. I have a follow-up question, but Greg, maybe give us your, how did you come into this asset class? What is it that attracted you?
So using Joel's falling down the proverbial rabbit hole, I mean, I literally fell down in the sense that when I came back to our family business, I was told that we'd made a small investment in a cross-border payments company, and would I just get an update on the business? So when I called and spoke to the CEO of the company, I didn't imagine what cross-border payments was in that sense. I thought he was using fiat currency, and he started talking about Bitcoin. So I immediately went through sort of the multiple stages. I was very dismissive at first, then became skeptical. This was in 2014, so there was a lot of discussion about Mt. Gox. So this was definitely an area we didn't want to be involved in. But then the more we learned about it, I became curious. And I love new technologies. And we decided to make another small investment, somewhat as an educational basis. And that investment started expanding, and we've ended up making about 30 equity investments in the space still then, you know. One of the things which is funny, and Joel and I have had the opportunity to speak before, is because we are family offices, we do have the ability to do things a little differently. We don't have to report to our investors every month and tell them why we're making these decisions. But I can tell you it was a challenge internally just to convince our family to invest. But I bring up the story that my father's told me many times. In 1951, my father met with his father and showed him a piece of plastic and said, look, Dad, I've got something called a credit card from a company called American Express, and this is how I'm going to pay for things. And as the story went, my grandfather looked at him and said, that's crazy. Like, you can't use plastic. You know, we have to pay with paper. And it's a little bit of the same idea now that we're talking about a digital payment system versus that plastic in the 50s or go back in time.
Great. All right, I have two quick follow-ups. Maybe, Joel, let me
Great.
try you first. I know you said it's not there anymore, but can you just tell us a little bit of the mechanics of one of these cross-exchange arbitrage opportunities? Like how did those work?
Well, it was a trade based upon sort of dysfunction at the time. And it was really a back office trade more than anything else, because anybody could see that Bitcoin was trading 5% more expensive, let's say, in an exchange in Japan. But to make the trade happen, you had to, open a bank account. You had to get a membership at the exchange. You had to move money around, which took time. And it was really, really hard to do. And so the guys who ended up winning were able to successfully navigate all of that infrastructure and get the requisite accounts set up to be able to move money around. It was a very clunky trade. This is all, this is decentralized. Blockchain by definition is somewhat decentralized. So you're dealing with all of these different entities separately. I heard someone say, tell a story about setting up something in Japan and talking to the bankers, and it just looked like a scam to them. Like, they wouldn't accept these guys' account because they're just wiring money out of Japan. Certainly it was fraudulent, right? And so it wasn't that long ago, right? This is 2017 that this trade existed. And by mid 18, it just didn't exist because people had figured out how to get those accounts set up. So, that's what I would call a real structural arbitrage. It was just a lack of infrastructure that created it.
That's really interesting. I mean, it reminds me of when people talk about bond arbitrage, like in Salomon Brothers and LTCM back in like the 70s and 80s, that was around, I guess, longer than 8 months, but ultimately it sort of got squashed away by the market.
Right, and they weren't playing for 200 to 500 basis point spreads. They were trying to get basis points here and there and lever it up. This was insane.
Yeah, that's fascinating. Greg, let me sort of piggyback off that. So you mentioned Mt. Gox, one of the big scandals. One of the issues with this space has always been one of lack of institutional infrastructure. And I think what Joel just described is how an institutional kind of arbitrage infrastructure was built in the course of 8 months. Does it feel to you like the space has become more institutionalized over the last several years, and that some of these early, crazy kind of things that used to go on are less likely now?
Absolutely. I mean, I'm sure we'll talk about it further, but the discussion has gone from, overseas trading by Japanese housewives to central bank digital currencies. I mean, the Chinese have a digital yuan now. We are actively developing a digital dollar. The euro is turning digital. The whole market has changed, and I'd like to think it's partly some of the companies we've been able to invest in, but you have now real exchanges, you have regulation, you have answers. I mean, we talk in crypto world sort of like dog years, that everything happens so fast. But over the past few years, I mean, over a year, so much happens in this world with development of technologies and acceptance of where this business is going. Yeah,
I'd like to add something to that, if you don't mind, Harry, and that is just that, at the end of the day, this is still an industry in its infancy. And it's also an industry that, like, is really, like, the idea of creative destruction applies to this industry incredibly, like, aptly, because this is software at the end of the day. And people are experimenting, and we see new experiments all the time. And so while it has become more institutional, we still have lots of failures, and that's not necessarily a bad sign. It just means there's so much talent that has come into this industry, and everyone is trying to figure this out. And frankly, nobody has the answer. And we're going to know who the winners are in a bunch of years, but it's still very much up for grabs.
Well, so Joel, maybe you can build on that. So you're mentioning how the landscape is evolving. So in terms of the opportunities that you see in this ecosystem now, like maybe talk briefly about that, and then we'll turn the same question over to Greg. Like what's out there now that's particularly interesting?
Well, let me, when you talk about what's out there, I think it's important to take a step back, and maybe for the benefit of some of those listening, like, this is an incredibly dynamic ecosystem. Just 3 years ago, it was only Bitcoin really, and back in 2017, Bitcoin dominance, that means how much of the market cap of these currencies was Bitcoin, was about 95%. So most everything that we're talking about has happened in the last 3 years. But since then, we have everything from passive beta strategies to invest in individual coins or even baskets of coins, like an S&P 500, if you will. Everything to sort of a pure alpha approach on the other side, which is much like I was talking about earlier, a pure ARB, to everything in between, to private investments, to, like you mentioned, Mt. Gox or bankruptcy claims. There's mining, there's staking. So there are a million different ways that people are looking at the space today. Like, for me personally, I'm always interested in capacity constrained strategies. And typically what I'm looking for is a strategy where there's volatility, where there's a lot of misunderstanding, and as one of a hedge fund manager I used to invest with called it, a lot of alpha donors. And those are like retail people who will donate alpha, who don't really understand what they're doing, but are trying it, but they're not necessarily as sophisticated as some of these managers. And by the way, I'll speak for Greg, we are not sophisticated, as you made mention of earlier, Harry. Like, we're not at the technical level of understanding all the protocols down to the level of code. That's not what we do. But in any case, if I can find something with volatility and real retail usage and complexity where it's changing quickly, I'm going to look there. And one of those spaces is DeFi today. But to be candid, I'm invested in beta products as well, because I do think there is at least a good chance that a lot of these tokens accrue value over the course of time.
Well, that's very interesting. Well, I'd like to come back to that a little bit later on, the question of value kind of and how you think about that. But for now, let's turn over to sort of that question to Greg. Greg, what do you think opportunities in the market?
This is where Joel and I differ immensely in our view of the market, because we really look at this as a venture opportunity. And that's how we manage it from our portfolio. We do invest in the top coins, which is primarily going back to, as Joel said, Bitcoin, Ethereum, and a couple of other coins, sort of as a generational hedge, and as a digital gold versus the traditional gold. And we've actually been putting on more Bitcoin purchases over the past several weeks because of that. And the other area besides, well, let me go step back, sorry. On the venture side, we like the technology that's being developed. And so if our ideal area is actually either picks and shovels supporting the digital currency ecosystem, or companies that are using blockchain technology to help their own businesses. So these are companies that, frankly, you could invest in as a totally separate business plan, but they just have an advantage that they feel by using this immutable ledger underlying their technology, for example, in ticketing or voting is another example. Bonds, I mean, we're looking right now at basically how bonds can be managed on a blockchain just from the whole default process. And it makes a lot of sense, or how something can be issued on a blockchain without having that third-party intermediary. The other area where we're paying a lot of attention right now is it sort of falls in crypto speak under the non-fungible token side, but it's unique tokens. And this falls into the areas of artwork, but it also falls a lot into gaming. And the idea where for the first time you can take an industry like esports and video games, where you literally have 3 billion people who are playing every day, who will have the opportunity to own and trade different assets in those games. So that's where a lot of our focus has slowly developed over the past few months.
That's really interesting. Can you briefly elaborate on this idea of bond issuance on the blockchain, like, and the default and bankruptcy process? Because nowadays that's very topical. I mean, we're sitting in a pretty big default cycle in the corporate universe in the U.S. Can you maybe just 1 minute, like, how would that look like? What does a blockchain bond issue look like?
So I'll even go back. I'll give you an example sort of from history because it's the founder of one of the companies. Lou Ranieri created the mortgage-backed security.
Yeah.
And as he looked at it and you were going through defaults, he realized very quickly, because he had servicing companies, that the margin on services are very low. You're running technology from the 1970s. And there's got to be a better way that all these companies can speak. A very simple but sort of ludicrous example is over the past few months, obviously a lot of companies have gone into default, but it's a structural default, but there's no way in the older systems to make a change that you can explain that. And they advised me at one point, I was talking to them about refinancing, and they told me to play hardball and sort of ask for a copy of my mortgage because people don't have these records. So what they're doing is they're creating a platform that servicers can use that'll, once a bond is issued, or a mortgage is issued in this case, it'll actually be placed on a blockchain. So you'll have a immutable record that for the remainder of time, different servicers can use. And yes, it's immutable, so you can't actually change it, but you can alter it or make revisions to it. So if my name changes, they can change it in the system, but you'll have now this one record that everybody can use at all times.
That's really fascinating. All right, thanks. So we've sort of touched on the idea that you guys think of this as an asset class and you're looking for, beta type opportunities and alpha type opportunities. How would you compare investing in the space to traditional investing, or investing in more traditional asset classes? Like, what are the similarities? What are the differences? Maybe Joel, will go to you first.
Well, I mean, there are a lot of similarities in a lot of the basics, right? When you're looking to invest in, hedge funds or mutual funds or, whatever it is, my background's in hedge funds, so that's how I think about it. Like, you're always trying to make sure that you're in a space that makes sense. Like where there is alpha to be mined. Like, there are parts of the universe, the investment universe, that are very efficient. I tend not to try to fish there because it's just hard to extract any alpha. There are areas of the market which are very inefficient and where, perhaps there's less competition. Like, I remember somebody once made the analogy of like a poker player. Like, the best skill in poker is making sure you pick the right table to play at. Counting cards is nice and knowing all the stats is great, but if you can be at the right table, that's the most important thing. And I sort of view investing through that lens somewhat as well. And I sort of spoke earlier about wanting to see volatility and wanting to see inefficiency. And finding that and creating a network and doing all the research, getting educated, like all of that is the same. It just so happens that like the underlying asset is, is very different and is, one of the big differences is the pace of change, which, either Greg or I mentioned earlier. Like this industry is moving so quickly that it's very, very hard as an allocator to really stay up on top of what is changing in the industry day to day or week to week. Now, I'm not an expert at anything I invest in. I understand stocks, but I'm not a stock analyst. That said, I can still invest in a long short equity portfolio manager. I'm not an expert at crypto, but I know enough. I would say finding great portfolio managers is even more important in this space versus, say, traditional spaces, insofar as it's changing so quickly. You need someone who can be on top of it or attempt to be on top of it, because at least according to the PMs that I'm invested with, it's hard for them as well. But therein lies a lot of the opportunity. So the pace of change in the industry, I would say, is very, very different. I would say the volatility of this industry is also very, very different. Like after you look at some long short crypto funds, and then you look at a long short equity fund or a bond fund, it's like going from cocaine to a juice box. It's just like totally different styles of investing in volatility. And so you have to size things appropriately. You have to pay a lot of attention of how something fits into your book. And while on that topic, I think it's important to know that underlying all of these investments, there is, like, as I said before, this is software. And software can be hacked. There are certain risks associated with this investing that one doesn't have to discount or underwrite in other forms of investing. And for that reason, at least for us, I know, we underwrite everything. We demand a higher return for every strategy we invest in. If it's like long short crypto or long short equity, we need more out of our long short crypto because we feel like we're underwriting different types of risks, including regulatory risk, which we may get to later.
Great.
I'll just mention a couple more things, just because I made a list. It's on my sheet here in front of me, and like I got a couple pages of things that are different, but I'll just mention a couple more. Like another thing that's tricky is that nobody has a long track record. When you look at a long short equity manager or macro, it's not uncommon to find guys with 5, 10, 20 years of track record, which you can dig into and you can understand and you can parse. Nobody has that sort of record in our world. Most guys that I invest with have a track record of 0 to a year. And so it's critically important in this space, probably more so than traditional assets, to get to know people and to really understand their philosophy and how they may be able to add value, because you're really not going to get that from a track record. And as I look down, I'm just going to see if there's one more thing I want to talk about. Well, why don't I stop there?
We'll come back.
We'll come back.
You're not done talking.
Go.
All right, Greg, same question. How is this different than investing in IBM and Microsoft?
And let me just start by sharing one story, how when we got started into it, but it really stresses Joel's comment on volatility. We made our first Bitcoin investment. At the end of the day, I looked at our numbers and we were up 4%. So I really felt that this is a great investment. I'm the smartest guy in the room and everything's wonderful. And I had a young child at that time, so I got woken up in the middle of the night, couldn't get back to sleep, and I looked on my computer and we were down 25%. And I literally was like, I can't go back to the office tomorrow. Long story short, when I got back to the office, we were back up 1%. So you've got to learn you need to have a good stomach for crypto because those numbers run all day long. But to show how the market's different, and again, I sort of look at it very differently than Joel. One of the first things we discovered when like everyone, when we invest in companies, there's certain provisions and restrictions we put on a company if they want to issue debt or new equity. And everyone else did that. Everything was fine. But we started something called token offerings and coin offerings in the crypto business that in 2016 and 17, nobody had written into contracts. And we have an example of a company where we invested a small amount and had a low single-digit ownership in this company. Their valuation was probably, $5 to $10 million at that time. They decided to do a coin offering, which we really weren't interested in. And when we spoke to our attorneys, no one understood what it was. A couple of months later, they did the offering and we talked to them. And I remember at one point they had about a year and a half worth of cash left to run operations. So, they probably had about $1.5 million, $2 million at that point. And when we started talking to them, we're like, how are things going? And they said, wonderful. And we said, well, how are you doing, from a burn side? And they said, well, we now have $95 million of equivalent on our balance sheet. And we were in shock and immediately said, well, that's great because our single digits are now worth a hell of a lot more. But the fact is we had no rights or claims to those tokens. And surprisingly, a couple of months later, everyone started writing contracts a little differently. So that was one area that really changed it. But besides hurting us, what it really did is it changed the alignment that traditionally exists between an investor and the managers. And we had several companies where several of our founders left about 6 months after we funded them because they made a lot of money. I mean, enough money to retire, and they didn't want to do this anymore. So it really changed how things are going. The other thing, because it is such an early adopting business, and Joel sort of hinted at it, a lot of things we take for granted don't exist. When you were looking at investing in funds, things like a custodian or administrator just didn't exist. And if they did exist, they certainly weren't something that a top accounting firm were comfortable with. There were questions of regulation that we typically don't deal with in early stage companies. And these were questions sort of, what is a digital asset? The IRS said it's property. SEC said it's a security. CFTC called it a commodity. FinCEN said they really didn't care what it was. And, the Fed said it's some innovation. Well, when you have everyone disagreeing on what it is and how it's handled, it makes it difficult internally how you look at it. The other thing, which I will probably get heat for saying, but I think I will get support from Mr. Gantcher in this statement, the traditional models and valuations that we're accustomed to in finance just don't exist in this world. And people have been working on adopting new models. Number one, some of them I think are very tough to accept, but a lot of them are very new and they don't have the history supporting them. So when you went in looking at how to invest in these companies and coming up with your own valuations, it really was a very different process than we're accustomed to.
Thank you. Let me just give a brief administrative note. So we have a few more minutes of discussion, this moderated discussion. I see people have already begun asking questions. So what I would encourage people now to begin doing is, if you have questions, please type your questions into the Q&A. And we're going to get to as many of them as we can, but I have a few more questions since I have the podium for the time being. So here's one question, sort of piggybacking off what both of you said. It's a new area. There's an ecosystem of companies doing business, and you mentioned a bunch of things like, legal and accounting, and I could also throw into the mix, the street does a lot of research on most asset classes, right? You can go to Goldman or JP and, they'll write about IBM and they'll write about Amazon and they have a Netflix model. Who does that in the crypto space? Like, who are the service providers? Like, if you want to get crypto analytics, or if you want to get research pieces, if you want to get legal services or accounting services, like, who do you go to? Who does this kind of thing in this space?
Well, why don't I start? I mean, there are firms a little smaller than Goldman Sachs, I'd say, who offer some of the research services. I think I don't think I know, several accounting firms and law firms have become the go-to firms that most hedge funds deal with. There are a couple of administrators that most hedge funds deal with. But, unlike the traditional world, if you trade, with any frequency, there are probably only one or two administrators which can really handle that work. And even then, there's a tremendous delay at times between like a month end and the time at which I, as an investor, might get an NAV statement. It's October 6th. No, yeah, October 6th today, right? I recently got a June 30 NAV from one of the funds I invest in. They're not being funny about it. Like it's some of this stuff takes a long time, and it is changing so quickly that these administrators are having a hard time keeping up at times.
I mean,
Greg, any thoughts? Yeah.
let me throw out on the research side. There are some companies that have started getting into the research, either by taking a very technical approach where they're trying to go in depth into the different protocols or blockchains. Other companies are taking a larger Wall Street approach. I mean, one company, in full disclosure, I do some work with them. I'm also a client of theirs, is Fundstrat, which is run by Tom Lee, who was former chief equity strategist at JP Morgan, and he ends up being on CNBC talking about this topic quite often. But it's funny because if we give you a list today of the top companies, especially with the admins, the accountants, the custodians, our list will only get better within the next 3 to 6 months. A year ago, it would have been very, very hard to give you lots of people, and you definitely were not going to get a top 4, accounting firm to talk to you. They talked to you, but they just weren't comfortable. That's completely changed, and now there's a lot more people coming into the space.
So, when like a finance guy like me hears about all this stuff and the volatility, my mind turns to things like options and futures and various derivative securities. Can you speak about that? Like, is there innovation happening along those dimensions as well?
Yes, there has been a lot going on in the options and derivatives world in crypto for a while now. Interestingly, when Bitcoin was first sort of talked about as a potential investment, it was presented as a call option to people. I remember being pitched, several years ago by guys who said, listen, there's this Bitcoin thing, think it's extremely interesting, think it has a chance to capture some percentage of gold or M2 or whatever they were talking about. And they're saying, listen, if this doesn't work, it's a 0. If it works, it's not a double, it's not a 5x, it's 100, it's 1,000, it's a something X. So oddly enough, it was positioned originally as an option. But that said, there are numerous different exchanges that are trading options and futures, so much so that, in fact, the liquidity of futures and options far exceeds that of the spot market.
It's really interesting.
Today.
Greg, on the company ecosystem side, do you see people so as the option market develops, presumably there's going to be people providing analytics around the options, other services. Are you seeing that? Is that an opportunity that exists out there?
You are seeing it, and you've got a lot of data providers at the same time. I think part of the issue is everyone comes to me and and Joel sees the same things. We're going to be the Bloomberg of crypto. And
yeah.
The immediate answer is, well, guess who wants to be the Bloomberg of crypto? Bloomberg. And all of these companies are looking at it. But you're getting analytics. But again, these are things, what's very unique about this is all of this information is readily available. It's all open source. It goes back to being software. So if you want to see any transaction, go on a browser and you look at a transaction, you can see it. So anybody can access it. And now there's a question over what's the best way to service that? Can you develop some methodology to provide better information to me than I could get just by looking at it myself? But from a ecosystem, I've never been in an ecosystem like this where anything I want to see is available for everybody.
Interesting.
Yeah.
So, another thing that you've mentioned, and I think kind of related to the options question, is the topic of risk management in the space and trade sizing. Greg, as you saliently pointed out, like these suckers can move a lot. So how do you, what's your approach? How do you think about sizing and risk management and positioning in the space?
Joe, want to start?
Well, yeah, I potentially have a little more, levers just because I'm typically investing in liquid strategies. Insofar as you invest in companies, you don't always have the option to sell, but certainly the way I think about it is there is the potential for catastrophic risk in this ecosystem. And so no matter how much I may like the risk reward of some of these strategies in aggregate, like I think of if Bitcoin goes to zero, how much am I willing to lose in my portfolio? And by the way, if Bitcoin goes to zero, Greg, you might disagree. Like I think most other coins are probably going to go to zero if Bitcoin gets hacked tomorrow, which I think is exceedingly unlikely. But let's agree it's not an impossibility. But if it were hacked, Bitcoin would be zero immediately. And I think most other coins would probably be zero because it would basically tell people that all this cryptography we've been talking about doesn't work as we had hoped.
Yeah, I mean, the way we look at allocation just as an overall business is we allocate into 3 buckets. We have our IRR projects, which fund our hopefully high multiple returns. And then we have our separate group, which is venture and early stage, which could also be lottery tickets. And obviously we'd like to get a good return here. And we look at crypto for the most part, except with a little bit of Bitcoin being a digital gold investment as just an inflation hedge in that lottery ticket market. And what people forget is investing in venture is still very hard. I mean, if you get a 20%, success rate on your investments, that's fantastic. And crypto's no different. I mean, it's not any, you need to have, it's a risk. And I think even if you talk to most people, they'll tell you should have, whether it's 50 basis points to 5%, up to 5% invested in the asset. I mean, you got to diversify anyway.
Is there short selling in the crypto currency land? Can you, right? Like that usually, in markets you think about like hedging, so you go long one thing, go short another thing. Is that something that's feasible?
It is feasible, but it's obviously not as developed yet. It's coming there.
Right.
But one thing, and I don't know if we said it well enough, when we talk about options and we talk about different traditional derivative strategies, for the most part, those are really built around Bitcoin, a little bit of Ethereum, but not any of the, frankly, 2,000 other digital currencies that exist today.
All right, I want to leave time for questions, but I have 1 or 2 more questions myself. So one of the things that you guys mentioned is that central banks are getting into the space, and people want to create digital versions of their own currency. So I guess the 2 parts of that question is, 1, how do they do that? And second of all, what effect does that have on the existing coins? And any thoughts with regard to that?
Go ahead, Greg.
So yeah, I mean, countries are clearly doing it. I think they're doing it for two reasons. The first reason is they want to have a more efficient system. And there's no better example than what the US has just gone through with our COVID assistance program, that we couldn't pay people money. I mean, it's insane. And I mean, I know there are a lot of discussions, well, why don't we just use Venmo? But if every American citizen had a account on the Fed's ledger, Fed's balance sheet, they could have just transferred, literally helicopter money, transfer that money right in. I think the other area where we as Americans may be overlooking, a lot of people are looking at a central bank digital currency as their own sovereign digital currency as a way to attack the US dollar supremacy. China clearly is looking at having a digital yuan and getting people to use that as an alternative. The Europeans are talking about potentially using their structure for settlements and a new SWIFT system. And that's why I'm very happy now the US government's much more active today than they have in the past. The one thing that I want to warn everyone, and sort of a phrase we came up with, we use a lot here, cryptocurrency started as a libertarian dream, but with central bank digital currencies, it becomes a tyrannical nightmare. Because for the first time, you don't have your money. I get paid a salary. If I go take money out of the bank tomorrow, I take $100 out of the bank, there is a record that I withdrew $100. But if I give you, Harry, 100, nobody knows. It's cash. It disappears. If I decide to give 100 people $1, there's no record of it. In the future, there will be a full record of every transaction. The government will know that I gave you how much money and when I gave it to you. And the government will have the right, if it is their ledger, to take money away from you. So it's no longer a question about paying taxes. They'll just sweep your account. And that is a big concern. And a lot of people are arguing that and saying, you know, we need to have self-sovereignty and control our own money. But when sovereigns are involved, a lot of sovereign power comes from currencies. I don't believe they're going to allow us to control it. I believe it'll be controlled by their own balance sheets.
Yeah, so put another way, they have almost nothing to do with, you know, like the cryptocurrencies that we've been speaking about today, which are, you know, by definition, decentralized. You know, when we're talking about a central bank currency, it has the word currency in it, but that's where it ends, sort of.
So do you think there will be any kind of, push out of the existing, set of, crypto assets, as well as like the stable coins that are out there, if we have a digital dollar? Like what impact does that have on the existing coins in the market?
Well, I mean, the short answer is I have no idea, but the slightly longer answer is, insofar as folks are investing in Bitcoin because, maybe they fear inflation, like Greg just said, maybe there's some privacy issues that might cause them to invest in cryptocurrencies. Maybe they want control over their money. Like whatever, like there are lots of reasons why people might own Bitcoin, which would not at all be threatened by the fact that the US government may have its own like digital currency over time. So, perhaps there is some overlap in that Venn diagram, but I think it's going to be, it's not going to be overwhelmingly impactful. I don't think, but like that's pure speculation.
I think on the stable coin question you asked, Terry, at last count, I found 175 different stable coins. And a stable coin is just a digital currency that's pegged to some asset. A lot of them are to the dollar, some are to gold. Yesterday, the first stable coin to the Singapore dollar was issued. I think those are going to be threatened. And I do think Bitcoin will slightly be threatened. I agree with Joel 100% from the privacy side. But the US dollar is the de facto black market currency today. And all around the world, and using South America, for example, things are priced in dollars. So I think those people would rather, or they'll be very comfortable having a digital dollar instead of having Bitcoin, because they can use it automatically in their market. And while it doesn't have the appreciation value, I mean, it's deflationary in many ways, that Bitcoin has, it's a lot better than having their local currency. So I do think for people looking at a store of value, there will be a threat, but I don't feel that Bitcoin will be threatened long-term, because to me, it really is this new generational gold. And if I can just give one example, I'm use my 9-year-old son. If I told my son, out of my generosity, I'm going to give him a bar of gold, and obviously it's buried in the background, backyard, you got to go dig it out. I'm lucky if he gets it this weekend. If I call him in and say I'm going to give him Fortnite V-Blocks, he'll jump up and down, scream, and run to his computer as quickly as possible. And these new generations are growing up on digital assets. That's how they think. That's how they learn. The whole generation will move away from gold. And one of the real challenges that Joel and I've talked about many times is, have we found any traditional gold bugs who are moving into gold stable coins? And the answer for the most part is no. They look at it differently.
Yep.
Interesting. All right, so I see we've accumulated an enormous number of questions, actually around 20. So I think maybe at this point it'd be good to turn it over. So Melina has been curating some of the questions. I think we'll turn it over then to Melina, and we'll try to do some Q&A with the audience. If you have more questions, please type them in. We'll try to get to them as much as we can in the 35 minutes we have left. So Melina.
Yeah, I just want to note that there are a lot of really great questions here. So I am hoping we can get to all of them. But in advance, if we don't, we can field more questions. I can actually send questions to Greg and Joel separately if people want to reach out to me after the panel. So a question from an anonymous attendee. How do you view holding Bitcoin versus physical golds or silver as a store in value, a value in the world of unlimited printing of fiat currency and quantitative easing?
Well, I do have some investments in miners of precious metals miners, gold, but we do have far more in Bitcoin. And so I guess that speaks for itself. I think there's a very good chance that Bitcoin does end up being a decent hedge. And by the way, one of the questions we didn't get to is like the correlation of like Bitcoin. Is it really going to act like gold in March? The market sold off and so did Bitcoin. So is it a hedge at all? Like what? And the truth is, I still think it's very early to know. Gold, by the way, sold off also with the markets in March. And I think gold has been fairly well established as a hedge to the market. But personally, just to answer the question, I do think a small piece of Bitcoin in a portfolio is a reasonable and an intelligent hedge against inflation, probably more so than gold going forward.
Yeah, I agree with that. Just add to, if you've got a transfer of wealth between generations from baby boomers that's coming up at $70 trillion over the next 25 years. And using the example I gave of my little son and his V-Blocks, if I give my children a bunch of assets right now, gold is one of the first things I believe they'll sell off. They don't appreciate it. They don't understand it. And if you look at our parents, they lived in a world where you actually had a gold standard. And that just doesn't, that concept doesn't mean anything to millennials or, Gen Zers.
Okay. So moving on to some other questions. And by the way, we're getting questions through the Q&A and the chat, and we're up to almost 30 questions. So I'm going to try and move through them. So what are your thoughts on private sector consortium style stable coins like Libra or CELO? And also combining this with another, how does your fund anticipate Libra's entry into the space?
Let me just hit that quickly. So everybody knew about Libra before it happened. No one anticipated its impact. And I think Libra's done more for digital currencies. It's driven the entire central bank digital currency discussion because of the threat of it. I think there will be many more privacy coins, but again, what is its real use? We've had a fight internally in our office between would Disney have the next privacy coin or Amazon? And I can guess that everyone on this podcast webinar right now, if I owed them money, I think they'd all be willing to accept an Amazon currency because all of us will use that in the near term. Versus if I say I've got this great token from my local pizza restaurant, unless you live near me, I doubt you're going to take it. So you're going to have more consortiums working together to build these coins. The real question is going to be the infrastructure and how are you going to custody it? So from a wallet, are you going to have an online wallet that's centralized by the company behind it? Are you going to have a decentralized wallet? And what are its uses? And if you have a major application where there's great adoption, it's going to have great use.
Apparently Disney has already issued Disney dollars.
They did, but no, they did. And I pulled them off. So I have to buy them on eBay. So I have them up on my wall.
They'll become classics.
They are. Yep, absolutely.
So this is always a great question. I actually love to ask people the same question, but really, what keeps you up at night in terms of your portfolio risk? What is the bear case and what scenarios would cause broad-based losses across crypto portfolios?
Well, definitely, as I've said a couple times, this is software. Software can be hacked. In the case of decentralized finance, which is a big topic today, like where these entities utilize smart contracts. There can be bugs in smart contracts. So there's real risk of problems with code. Honestly, that's what scares me the most. Number two is regulation.
Mm-hmm.
And, it's something that I think the industry has done a relatively good job. Well, I think the industry has done a relatively good job trying to educate policymakers and regulators. And from what I hear, because I'm not involved, they've been receptive. But it is a question mark. And, that's what keeps me up at night.
Yeah, I agree. The regulation issue has really changed and there's a lot greater clarity today. But the big bear case is if suddenly, the Bitcoin blockchain was hacked. Because in every report you've heard, and there was a hack in an exchange over the past few days, which cost about $200 million. There has never been a failure in the Bitcoin blockchain. It's all companies that are operating or working with that blockchain. But if suddenly something would happen there, it questions the whole basis of this infrastructure, that you have this, decentralized and
Immutable ledger
system that can operate without a third-party intermediary. That's the beauty of this.
Okay. So now I'm going to move a little bit into valuation and value creation questions. So DeFi was mentioned earlier in the discussion. Tons of activity there in the last few months, but mostly from speculative behavior like yield farming that has driven massive price appreciation in TVL. How do you think about investing in this space when there's often such a big disconnect between fundamentals and price, which arguably is going on in many asset classes right now, but particularly in crypto?
Right. I think the answer is extremely cautiously. That's how you approach it.
Yeah.
But, ironically, within the DeFi space, like there are companies with earnings. Like, and so if there are any tokens where you can come up with a valuation, some of the companies I'm thinking of, like, like maker tokens, where there are earnings associated with that token, there's probably more valuation work that you can do on a token like that than, I'm trying to think of one where it's easier to do it. Like there's earnings, there's cash, and there is a market cap associated with it. So, but the truth is, whoever asked that question is right. There's a lot of nuttiness going on. Like, although I will say sometimes some of this mania, the speculation, accompanies technology as it's like moving from stage 1 to stage 2 or 2 to 3. And that's sort of, at least some believe that's a normal part of the market cycle.
But hitting on what Joel just said, I mean, again, this is software. So I can take any one of these protocols and I can copy it tomorrow and call it GregCoin or do something else with it. So you need to do your homework and you need to understand what it is. And look, Joel and I both know many people, and I don't think either of us have done it, but who are just buying because a new coin was issued today. Or, there's something called Coinbase is the largest exchange in the US. And there's the Coinbase effect that when they announce a new coin, it goes up considerably. The last number I saw was about 20%. And there are people who will buy it without knowing what it is. But I could say that I know a lot of technical traders who are trading and they have no idea what the underlying assets are in a traditional market. And that's just how they're going at it. But you have to be cautious. And I would not size your crypto portfolio towards the speculative side. I mean, there are real investment opportunities and real returns that can be generated still in this market today.
Thank you. What are your thoughts on investing in exchanges versus custodian versus brokerage, et cetera, in the crypto ecosystem? Which type of participant attracts you the most?
Greg, you can take that because I don't really invest in them.
I'm going to start out by giving the regulatory environment. Where is it? I mean, there are a lot of exchanges overseas that are not, they're very gray around how they're looking at the AML KYC side. So we would not be very comfortable investing in an exchange, for that matter, outside of the US and Europe primarily. I think from it's adoption and it's looking where the numbers are. A lot of people have come in and said they want to be the next Goldman Sachs, the next JP Morgan. Again, JP Morgan and Goldman Sachs want to do it. JP Morgan and Goldman Sachs are looking at crypto. They're looking at it the next level, which is tokenization of all assets. So I think to create a new exchange today would be tough. The custodians have done a very good job so far. That said, while there are very specific ways about how you would custody a digital currency, either hot online or cold, which is offline, a lot of them are storing them in former nuclear bunkers, for example. If I could tell you, and this is absolutely not true, but if I knew and told you that, I don't even want to mention it, one of the major banks everyone knows, who everyone's comfortable with, was going to custody digital currencies by just writing down a private key on a piece of paper, which goes against every rule you should follow in crypto, people would be comfortable. I mean, we don't lose sleep over keeping our money in our banks today, even if you have more money than FDIC covers. The equity we hold at UBS, JP Morgan, I actually now ask for the first time how they custody our assets, just because I've learned about custody and I'm more curious about it. But they're just areas where there will be more adoption, and we're looking at it. We're looking at ways right now. One company we looked at today is how a Latin American market can access Bitcoin. How can we get the product to people? That's what's really interesting us, because this also serves the unbanked population. I mean, there's a major use for this. And so if we can find more applications that benefit from the technology, that's where we're going to look at it. You know, on the coins itself, it's looking at the underlying protocols that are building these things. A lot of different projects are working on identity, whether it's personal identity, where it's the ownership of assets. If I had my house, we have something called a title office in the US. Makes no sense to me. What if I own my actual title on my, digital wallet? And if I wanted to sell you my house, I transfer that asset to you. I mean, it makes sense, but we're just not at that level yet.
So speaking of the banks, the big banks, with a lot of them nervous to service crypto exchanges or currencies because of the AML risks, in your view, which banks have actually gotten comfortable with crypto and are, quote unquote, ahead of the pack in terms of go-to banks?
I believe JP Morgan is the largest investor in the digital currency space.
Okay.
What I can answer is the alternative question is which bank has stayed away from it?
Mm-hmm.
Every major bank is publishing reports now.
Yep.
Not reports in the traditional, equity style, but they're all actively looking at this. They're hiring teams. A lot of people who've left those banks over the past few years are now going back to work there. I mean, the future is tokenization of all assets.
Okay. Let me look through here.
Actually, can I jump in first? I had a follow-on to all the stuff that you said. So Joel, you mentioned that, there are some pure alpha opportunities here, and also you've both just described how the space is getting more crowded and the traditional banks. Like, are you seeing that yet? Are you seeing like a diminution of the alpha that's available because of all these new participants?
Yeah, well, I think generally speaking, as a rule, the life cycle of an alpha in this space is far shorter than the life cycle of an alpha in other spaces. Like from what I have seen, and that makes investing in the space like a real challenge. You have to be very opportunistic, and the smaller the opportunity, the more of a chance that alpha might be more resilient, because larger players may not be able to hit it, but then the smaller the opportunity is. So there's always that balance that you're trying to strike between being able to put assets to work and finding an alpha that is sort of repeatable and can stand not the test of time, but at least hopefully several years. But yeah, they degrade very quickly.
Yeah, a lot of companies we've spoken with are completely pivoting on their strategies a couple of years later. But I really want to stress what Joel just said about size. This is not an industry unless you're involved in the sort of fund side from either going long tokens or pure venture, where you can put a lot of money to play.
How do you source venture deals?
I call Joel.
I call Greg.
Network.
It's a small community, but there are a bunch of
Yeah.
funds, and it's built up over time. But it still is a very small group of people, and everyone's
Right.
sharing information.
Yeah, and the other thing I'd say is that there are not a lot of family office. There aren't thousands of family offices that will actively look at and allocate to this ecosystem. And so I think that gives those of us who do focus on it a bit of an unfair advantage versus any other ecosystem we might be operating in.
And so you aren't, traditional asset managers, right? You're family offices, so you have more patient capital, you have strategies. You're not answering to institutional investors necessarily. So there's a question about traditional asset allocation models, which require the estimates of expected rates of return, volatilities, covariances of different assets. So how would you forecast these necessary inputs to asset allocation models for crypto?
Okay, well, to apologize to the person who posed that question, I think all of it's a bit silly, the whole asset allocation model, and I've never really utilized that. That said, like the one thing I would, if you were to use that, I would be extremely careful about looking at Bitcoin's limited past and trying to forecast based upon that. Because I think Bitcoin from 2021 on is going to look very, very different from Bitcoin 2012 to 20. So if you want to use that model, just use it very, very cautiously, because I think it could lead you to some wrong conclusions if you do otherwise.
So how do you establish target prices then? Like, is that part of, you know,
Well,
when to buy in, when to sell? Like, what are you
yeah,
looking?
we don't buy a lot of tokens ourselves. We are most always hiring people to, you know, whether it's hedge funds or active managers, to make those decisions for us, because, you know, frankly, I wouldn't know how to tell you what a price target on Bitcoin is. I will say that the more pressing issue for investors in this space can be, you know, let's say you put 2% into Bitcoin because you want a little bit of diversification and you think it might be a good performer over time. Well, when Bitcoin goes up by 4x and it's now 8% of your fund, it's way too big, right? And so I have found that a lot of my selling has been due, historically at least, has been due to the fact that things have appreciated and I need to right size it within a portfolio, but not because I think Bitcoin is too expensive or too cheap. It's a portfolio management issue, which gets back to my idea, like I don't want to lose more than X percent if Bitcoin goes to zero. That is my primary risk management calculus.
It's well said.
Great. Interesting. There are a couple of questions related to transaction speed and energy efficiency behind the whole system. You know, when you talk about JP Morgan, I think also of JP Morgan being a major player in the global payment space. And we've had their head of global payments come in and speak in our courses at Columbia Business School, really talking about the difference between transaction speeds and why they matter in the banking system and also in the retail system for us as consumers. So if you guys could talk a little bit about these frictions or inefficiencies, also transaction fees as it relates to processing when they're used as currencies, it would be great to get your perspective on that.
Should I start?
Start, please.
Throughput, or transactions per second, TPS, is a metric that is watched closely among folks in the ecosystem. And the fact is that the two major protocols, Bitcoin and Ethereum, have extremely limited throughput. I think it's 7 transactions per second or something like that. It's single digits, whereas Visa can probably do thousands per second. I don't know what the number is. That is a critical choke point in this infrastructure today. And you know, you've seen the effects in the Ethereum network upon which DeFi has been built. And the transaction costs for utilizing the Ethereum blockchain, as measured by what are called gas fees, have really skyrocketed to reflect that demand. Most of these protocols have what are called layer 2 solutions being built upon the protocols in order to facilitate more rapid throughput. They have been in development for years. I don't know exactly. You have the Lightning Network on the Bitcoin side, you have others on the Ethereum side. It's unclear to me exactly when they are going to be done or ready, but it is a major problem. I will add that one of the reasons why DeFi has grown the way it has is because when you're lending money in a decentralized finance application, it doesn't involve thousands and thousands and thousands of transactions. I lend Greg money, 5 months later, you know, I lend it to him, I get the money back. It's not transaction, you know, it doesn't rely on tons of transactions, I guess is what I'm trying to say. So that sort of ecosystem has been allowed to flourish. Others have not. And, inevitably, I think we will get much more rapid TPS throughput. And it'll be interesting to see what sort of protocols thrive in that environment, because it will likely be different than what we're seeing today.
I mean, at the end of the day, it's right now 8:18 p.m. If you want to send me money, Melina, you can send me through Venmo, but the fact is you can't get into my bank account right now. And if it's a holiday, you definitely can't get it into my bank account. And with digital currencies, you can send it to me and I can get the confirmation in seconds at a very low cost. Joel's 100% correct. I mean, Bitcoin has gone away from being a true currency as a medium of exchange. I think the real discussion now is the digital store of value. But we see what can be attained. Joel talked about if I lend him money, it can be peer-to-peer through a smart contract. So contractual code will set up the rules. Contractual code will enforce them. We don't have to go through an entire loan process. It's much quicker, it's much more efficient, and there's less friction involved. So I absolutely believe this is where the market is going. And in discussions with major banks and others, this is where they'd all like to go. It's just a simpler system.
Well, they are enacting systems. Zelle is a system, and it's a system with a consortium of banks, so it makes us able to transact instantaneously from account to account. It's just they're not using, from my understanding, the same platform.
Yeah, but I don't believe with Zelle you can get me the money. I can't have it literally in the sense that I can give it to other people. It's a little bit more like the Venmo's side that you have it, but it's not in my possession. You're still using that bank as an intermediary. I mean, if you send me money, you can't give me that cash right now. We've got to wait. Well, we can go to an ATM and get the money.
Right.
Here, you have full control.
You got a bunch of people. You got a bunch of people telling you you might not be right, but
I may be incorrect on it. Okay.
That's great.
I don't have a point of view. The point is that centralized, like blockchain-based systems are not more effective and more efficient than many centralized systems today. They're just not.
Can I ask you guys, actually, can I jump in for 1 second? So you've both mentioned this, but maybe I can phrase it as a direct question. Like the initial, and I think, Greg, you mentioned it, and now, Joel, you just referred to it. When Bitcoin was invented, the whole point was this kind of pseudonymity, like not total anonymity, but like you kind of, it's decentralized. People don't know who you are. Like Greg said, you can send money right now to someone else as long as you're both fairly technically savvy. But then you introduce custodians who hold your coin on your behalf, and presumably they have a record that you own this set of coins and they're regulated. Like, how does that play with the original, ethos of the Bitcoin system? Like, does it sync well? Is it fundamentally opposed to the original philosophical view?
I think from the original philosophical view, the idea was to get control of the ledger. I mean, that's really what it was. Privacy wasn't the original idea, and there are some privacy coins that have been developed with it. I mean, Bitcoin is not a private coin. And you just said it. If you have a custodian, if you have an exchange, the KYC process you've got to go through today is very stringent. And again, every transaction is immutably recorded on these ledgers. So we see constantly, there's stories now from 2016, there was a hack in Asia. The money is moving today. So the minute I send Joel money, you may not know who we are. It could sort of be like a Swiss bank account if you want to look at it that way. It's a numbered account. But that record is there for eternity. And if you talk to any major regulator in the US, they're all very actively following this. The FBI is hiring people to look at blockchains for them to track where money is flowing. You can absolutely record the flow.
Yeah, if you're a thief, you don't want to be using Bitcoin.
Yeah.
So do you then not believe, right? So one of the big stigmas has been like it's used for money laundering. You've mentioned AML. Like, is that not still one of if not the major uses, but one way that it's used, like to sort of move money?
It is, and it's a very small amount. It's more used in ransomware. And if you look at a lot of ransomware now, these are small amounts that people aren't really going after. They're not asking for $50 million. They're asking for $15,000, which people may just not pay as much attention to. But I mean, you can track, again, every transaction is immutably recorded. So you can track it and we can follow where it's going. And while it may be anonymous, at one point, someone will probably take it to an exchange and try and cash it out. And when that happens, first of all, the records, when people are stealing money and it's going to different addresses, the exchanges start blocking those addresses so they won't accept money from them. But if I'm going to blame Joel, if Joel may have been involved in nefarious activities, sends me money, I'm a very innocent person, I send it to you, Harry. When the police come to you and step on your doorstep and say, okay, we're arresting you, where did this money come from? You'll quickly tell them that you got it from me, and I will take the blame for my buddy and not turn him in.
Very noble.
Thank you, Greg.
Anytime.
So Greg, just kind of fielding questions here a little randomly. A question about mining for you. It was mentioned earlier that you sometimes get involved with mining. So the question is, could you walk us through the mechanics about mining for crypto? Do you use your own equipment? Do you utilize a third-party miner? What is needed to mine and what are the costs involved? I think someone's interested in mining.
I'd like to follow up on that later because that literally is, you can't do that justice in a couple of minutes.
Yeah, no, that's a big question. Okay.
Yeah, can I just answer one part of it?
Sure.
Do not do it yourself.
Okay.
To back that up, we run data centers and we do not mine digital currencies.
Got it.
Can I, guys, since it's a Columbia talk and as Melina looks for maybe one or two more questions, here's a question I had. Like people, we probably have students on and they're thinking, what should I learn to be a participant in this space? Like, should you send them off to take computer science courses? Should they be focused on, capital markets, which I happen to teach? Like, what's a good educational background to become, proficient in this area?
Well, the unusual thing about the ecosystem is, like a lot of these tokens are a mix of game theory and cryptography and coding, software and capital markets. It's really a meld of a lot of different fields. And I would say, like, starting at any one of those fields is interesting and can quickly lead you to others. And that said, there's a ton of excellent material today on the internet. If someone just wants to get up to speed on, what is Bitcoin or Bitcom, as my mom says, how does mining work? Like, there are a lot of interesting articles, even books today that are quite good. And Greg, maybe you and I can put together a quick little list of some things that we can pass off to Harry or Melina, and they can share it with folks if they want.
I think the answer is sort of as Joe said, and it's the genius of Satoshi Nakamoto, who is the, unidentified developer of Bitcoin to begin with. He really addressed so many different areas in coming up with a system. And you can look at it from so many ways. And I think at the end of the day, companies, if you even want to take a traditional corporate, view, companies will use blockchains, and we just won't talk about it. I think that's one thing we didn't address when we were talking about investing in the space. In 16, 17, and 18, every investment we made in companies, the first bullet point was we're using a blockchain, like flashing blockchain, do we get your attention? Now we're involved with projects that I happen to know uses a blockchain as the underlying technology. They don't even tell you. And if you ask, they'll be happy to tell you about it, but it's not necessary to them. Their objective is to tell you what solution they're providing.
Thanks, guys. So Melina, I guess we have a few more questions we have time for. What do you think?
Yeah, I've hit on most of the questions that I think are, that are broad questions and related to the topic. I guess one question really is about the secure cybersecurity of this entire space. So if you are a holder of Bitcoin, how do you protect yourself from hackers? What is the risk of the entire system essentially existing in a virtual cyber world?
Well, if you own Bitcoin, there are really two options. One is that you work with another entity, whether that's hiring a fund manager or and they hold it for you, or
Okay.
you can have a wallet which contains the Bitcoin, allows you to store your Bitcoin yourself, really. Um, I can tell you that it's still not an easy system, and it has a long way to go before it's easy. Most of our, almost all of our investments into cryptocurrencies are through other entities that may have a passive index or may have an actively managed index, but they're holding that cryptocurrency, utilizing administrators, custodians, etc.
I mean, this goes to the question over hot and cold wallets also. If it is a hot wallet, it's on an exchange. So it can be hacked, and exchanges are hacked. A lot of exchanges now have insurance, which is a subject we talked about 2 years ago, started getting a year ago, and now major exchanges are getting insurance from people like Lloyd's of London. If it is a cold wallet, and I'll tell you, we keep our Bitcoin on cold wallets at a safety deposit box or in a safety deposit box in a bank.
Where? Which one?
That I won't show. It's in my neighborhood in New York, I'll tell you that. But guaranteed it cannot be hacked because it's like a USB stick, it's offline.
Okay.
So if you steal that USB stick, great, it's a bear bond in that sense, so you really have control. But as long as it's offline, there's no problem. But like we've been doing this for 5-6 years now, and it's awkward when you send money to people. It's not a simple system, and it's a lot better than it's been, and it'll be better tomorrow. Different ways are being developed that are making it easier. On my wall, and I can't sort of show everyone, but I have a AOL disc, an original disc that we all used to get in the mail and in the supermarket, and we hated them when we got them. And that's where we're going to go with this technology. And in '92, I learned something called TCP/IP, and I was using an FTP server to send digital messages to people. By 1993, 94, 95, we all got these AOL discs, and we were able to send electronic mail to people. And we didn't need to learn that underlying protocol. And that's sort of where the crypto industry is today. We're still talking about a lot of very, very technical questions, as Joel mentioned earlier, when you go into layer 1 and layer 2 protocols, that if you go buy money on Coinbase today, you don't need to worry about it. You just go in, you go to Coinbase, you buy Bitcoin, they store it for you. You can go online and look at it like it's your local bank, and you can transfer it. They're taking away a lot of that friction. The irony is it's not decentralized. They're fulfilling the same service that your banks do today.
Yeah.
And I have no investment in Coinbase. They're just the largest exchange. So, they're a good example.
This is a good question, actually, given our audience and just you are larger scale investors, average individual. So what are some specific ways for retail investors to allocate a modest amount into blockchain and or crypto investments?
I think what Greg said makes the most sense. If you want, you can buy $10 worth of Bitcoin on Coinbase. You set up an account. You can then buy a Ledger wallet. and you can download it onto your wallet, your digital wallet. I mean, that was one of the first things I did to just sort of get a sense of what the, you know, how it works. Like, I am a big believer in just playing with it a little bit to give yourself more of an understanding of how it works. And you can do it for almost no money.
Yeah, and that's exactly what we tell people to do. I mean, in fact, one of the groups, there's a trade organization called the Chamber of Digital Commerce, and they're actively, obviously, trying to promote the ecosystem in Washington, D.C. And they literally announced a program yesterday where they're sending $50 in Bitcoin to every member of Congress. So they receive it, so they learn how to use it. And that's what we tell everybody.
Right.
When
It just, oh, sorry.
No, I throw a political joke right now in it. When we talk to people about digital currencies and Bitcoin, and the conversation's changed. We're no longer starting the conversation, what is Bitcoin and how does it work? But we tell people it's a little bit, when you're talking to people, it's a little bit like talking about our president today. You have an opinion, I'm not going to change it no matter which way I come at you, but you need to understand what the technology is. And we've been preaching that we believe that digital currencies would evolve and you would have central bank digital currencies, and that's happening. And it's going to continue further through the tokenization of assets. So we just tell people learn about it because this is something that we strongly believe will occur, and just get an understanding.
And that's a great note to end the seminar on. Learn, always, and try and understand, go to the primary sources, understand the facts before you have opinions. I like that. Also with politics. There were a few comments from the audience just saying it was a great panel. Thank you on behalf of the audience to all you, Joel, Harry, and Greg. And also a reiteration that that list of books and articles and resources would be very valuable. And I can take responsibility for circulating that to the registrants. That's
Yeah,
it.
we'll make sure to get it to you. You know, thank you, Harry Molina, for allowing us to participate in this. And I'm just sorry that we couldn't have this be a more personal sort of get together. You know, Greg and I have done this before, and it's a lot more fun when you're in a little room, but I think this is great, and Harry did a great job, so thank you.
Yeah, thank everyone for coming tonight.
Yeah, thank you everyone for participating. Thanks, Melina, Joel, Greg. Huge thanks to you guys for taking the time to talk to us. Hopefully this is, you know, talk number one, and we'll have a talk number 2 and 3, maybe in person.
Yeah.
Okay.
Medical community facilitating that, hopefully. All right. Thank you, everyone.
Thank you, everyone.
For spending your evening with us. Very nice.
All right. Bye.
Bye.